Have you found that your credit cards are getting super high balances and maybe the payments are getting a little out of control? Well, this video is probably for you. My name is Scott Hastings. I'm a loan officer and mortgage broker based in Charlotte, North Carolina. And today I just wanted to talk about a comparison and contrast between a home equity line of credit, a cash out refinance, and a debt consolidation loan. And then also at the end of the video, I just wanted to touch on why I think you probably should never, in my opinion, do one of these debt relief programs. So let's just get started. In this video, I wanted to use a mortgage balance of $300,000 as your current mortgage balance as an example. And I just want to use $50,000 as an example for credit card debt. So the first thing I think you need to look at is why are you looking at doing this? So if you have maintained your payments, you still have a good credit score, and you're just tired of paying so much interest on your loans, then what you might want to look at is getting a home equity line of credit. So what that is let's just say you bought your home in the last, say, 5 years. You probably got quite a bit of equity in your house. A home equity line of credit allows you to keep your current mortgage and mortgage rate and then just get a second mortgage for, let's just use the $50,000 example. For $50,000 of the equity in your house, then you would use that to pay off all the credit cards, and then you would just have that one payment. And in this example, we know that credit card rates are, at least 28% right now, a lot of times higher. And a $50,000 balance with a 28% interest rate has, for probably just the minimum payment, still $2,000 a month in payments. And if you're in that situation, you know that. That $50,000 with an 8% interest rate in a home equity line of credit is going to be like more like $367. Now, let's just say, for example, that you have not been able to make your credit card payments, or your credit score has taken a hit just because the credit card balances are so high, you got everything maxed out. And that's really a lot of times the situation. Well, we know that if your credit card balances are maxed out, even if you haven't made late payments, your credit score is going to take a big hit. If you don't have at least a 700 credit score, you probably can't even do a home equity line of credit. You would have to look at either a cash out refinance or a debt consolidation loan. So a debt consolidation loan is really kind of another name for a personal loan. That's what they used to be called, because it's not tied to your house, it's not tied to your car, it's not tied to anything. In essence, it's really just another loan, really a big credit card loan used to pay off all the other credit cards. And it's still going to have a high interest rate. If you have a decent credit score, it's not going to be as high as a credit card maybe. But if you, again, haven't been able to keep up with your payments and your credit score is taking a hit, then the interest rate could be even higher. And a lot of times what people use debt consolidation loans for is just to get more money and really, unfortunately, just keep spending and using that to make the minimum payments on the credit cards. That's a massive trap. It's just going to end in tears. So don't do that. What people maybe don't realize is that you can do a cash out refinance even if your credit has taken a hit, as long as you have equity in the house. And you may need a little bit more equity because you might not be able to access as much. But, as a mortgage broker, for example, I have programs, FHA loan programs, where you can really go down to a 500 credit score and still do cash out on your home. What that would allow you to do in that same example, you would still be able to, let's just say get an interest rate around 8%. And we'll use still a $367 payment amount. So you're going from $2,000 to $367, except for you would be refinancing your current mortgage as well. So you just have to look at that, see what the new payment would be. But what it's really going to do is it's going to allow you to not, well, possibly declare bankruptcy and lose the house anyway. And it'll allow you to clear up all those credit cards and just have one payment. Also, that one payment, since it's mortgage debt, is going to be tax deductible. So you can write that interest off on your taxes at the end of the year, which is a huge benefit. Now, I also, like I mentioned in the beginning of the video, wanted to discuss why a debt relief program, in my opinion, is just a really bad idea. So a debt relief program is where they say, hey, we're going to negotiate with your creditors to where you will have, cut maybe the credit card balances in half and cut your payments, way down. And then maybe put you on a 4 or 5 year plan. Well, what happens is your credit just gets completely destroyed, because the first thing they do is tell you to just quit paying the credit card so they can negotiate with them. So your credit is going to be absolutely destroyed for 4 or 5 years. Also, they're going to be charging you additional fees to do this. And sometimes you might still not be able to pay off all the debt, and it could just turn into an absolute nightmare. So I would say by no means do a debt relief program. I have not seen them work or end well in the past. There might be good results. I just don't know of them. So I hope this video has been somewhat helpful, again, to help you decide whether a cash out refinance might be right for you, maybe a debt consolidation loan under certain circumstances, but never a debt relief program. If you found this video helpful, please hit like and subscribe. If you have any comments, obviously put them in the comment section below. And if you would like to talk about doing a cash out refinance, again, possibly down to a 500 credit score, just go to my website, mortgagesbyscott.com.